Are you curious about where mortgage rates and the real estate market are headed in 2025? Whether you're looking to buy, sell, or just understand the trends, this video has the insights you need. Let's dive in. For 2024, I predicted mortgage rates would trend lower with a continued decrease in inflation and multiple Fed rate cuts, while Hawaii home prices would remain strong. As you can see, mortgage rates did trend lower, inflation dropped, and single-family home prices rose 4.8% on Oahu. In addition, I predicted AI would begin to increase U.S. productivity, helping the U.S. economy grow despite recession risks. Indeed, we saw U.S. GDP continue to grow with increased productivity despite some weakening economic reports and recession indicators. For 2025, I expect mortgage rates to continue trending lower, though with fewer Fed rate cuts. While some experts predict rates below 6% in Q1 2025, I believe they'll remain higher for now, with a drop below 6% more likely by 2026. I also expect inflation to keep declining as long as the money supply growth rate stays below 6%, the level noted economist Steve Hanke identifies as necessary to sustain 2% inflation. With the money supply lower than 3 years ago, inflation has already dropped significantly with a 1 to 2 year lag. This trend will continue as long as money supply growth remains suppressed. The bond market has reflected fears of rising inflation due to the tariffs President Trump was expected to implement. However, no tariffs were included in his first-day executive orders, and any tariffs that ultimately go through may be much less severe than initially feared. As a result, bond and mortgage rates have dropped the last few days after rising post-election despite lower than expected inflation reports. Even if significant tariffs are implemented, their impact on overall inflation will be less than expected. While some goods would see higher prices, a stable money supply would lead to price adjustments elsewhere to offset those increases. Also, tariffs and potential trade wars could slow the economy, ultimately reducing inflation in the longer term. Even if bond yields remain elevated this year, mortgage rates will likely move lower by next year as the risk premium, the spread between the 30-year mortgage rate and the 10-year Treasury yield, drops towards its pre-pandemic historic norm of 1.5 to 1.75%, down from the current level of around 2.5%. However, it may take more time for the risk premium to fully normalize, so I expect 2026 to be when we'll see significantly lower rates. Regarding real estate, I expect single-family home prices to remain strong despite repeated predictions of a housing crash from some commentators. Check out my previous videos for an in-depth look at why a housing crash won't happen anytime soon. Millennials reaching home buying age and limited housing supply continue to fuel the market. The two largest generations ever both want to own homes, but most baby boomers aren't ready to sell yet. Declining mortgage rates will bring more buyers off the sidelines, increasing competition for limited inventory and resulting in more multiple offer situations and a rebound in sales volume from the record low levels of the past 2 years. This chart from respected Hawaii economist Paul Brubaker highlights how declining mortgage rates drive higher sales volumes. It highlights the potential for pent-up demand to boost sales in the years ahead as rates decline. Inventory for Oahu single-family homes remains below 3 months, even with elevated mortgage rates. New home permits in Hawaii are now a fraction of the levels in the 1970s, despite a much larger population with far less buildable land. This chart shows that Oahu remains more affordable than in some past periods, with further improvements likely as rates decline. Globally, Honolulu ranks 150th out of 281 cities on the price-to-income ratio according to Numbeo, making it relatively affordable and appealing to international buyers. While state initiatives to add affordable housing units may improve accessibility, existing home values will remain strong. One risk to economic growth that could accelerate a decline in mortgage rates is the proposed deportation of over 10 million undocumented immigrants. Such a move would significantly impact industries like agriculture and construction, which rely heavily on immigrant labor and would exacerbate the housing shortage by reducing the construction workforce. The U.S. needs young immigrants to help sustain an aging population and to avoid the plight of the Japanese economy. Expanding legal immigration significantly to offset deportations could help sustain long-term economic growth. In summary, I expect mortgage rates and inflation to continue trending lower in 2025, with Hawaii's housing prices remaining strong. The overall strength of the economy will depend on the extent to which proposed tariffs and immigration policies are implemented. While these measures would increase the risk of recession, I don't believe they will be fully implemented in 2025. If you found this video helpful, please share it with anyone navigating the housing market. Please like and subscribe for a lot more useful information to come.